example of that conversation. So the founders, they wanted to sell it for $250,000. So $250,000 cash, right? They don't want to, so as I'm sitting in, you know, this call with them, you know, of course, all kinds of due diligent questions happen. But the end of the day, this is where it connects to Steven's question. Now, all of you guys in this room, okay, as you listening to this, place yourself as the founder of that NFT project. Let's call it XYZ. You just made about $200,000 worth of NFTs within the last 5 to 6 months. You've just launched the Genesis, and the Ethereum now is down. So if Ethereum is like, it dropped like what, to 1,300, I believe he sold anywhere between 1,800 to 2,000 Ethereum so now his Ethereum wallet is down. So picture yourself as that founder. What do you do? Will you be the same as that guy, go out and hunt a buyer like Jenny Ta to sell your entire collection, and you just toss the price out there, $250,000, Jenny, buy my entire collection, everything is yours, okay? Or do you find another method to keep going? You only have two choices, A or B, right? This leads back to Steven's question about the Reg A plus or the Reg CF. What the heck does that even mean? Okay. Now, back to the guy. He wants to sell. Now, on the opposite end, he has to find a buyer, which is me. Why didn't I jump at it to buy? Let me give you just 2 to 3 quick scenario. Number one, an NFT collection, even though people are saying, oh, I got IP this, I got IP that, there isn't really any true value. There isn't really any true value. Now, yes, I and my team drop an NFT collection to as well, called the Vitalik the Goat. But because of my traditional finance side, there isn't any other NFT collection out there that is connected to real world assets like that of the Vitalik the Goat. Or have you guys heard of V Friends? VEE by what's his name? What?
Gary Vaynerchuk.
That is correct, by Gary V, right? Now, if Gary V is one of you guys in here, now I'm sorry, I'm not trying to degrade anybody. I'm just giving an example here, meaning that Gary V, which is the NFT collection called V Friends, if it isn't connected to his name, Gary V, and then how he has events and he has this, and he's trying to connect all of his NFTs to his real, that V Friends NFT collection is too a piece of shit. And actually, even though it's connected to him and all of the promises that he's making, oh, whenever he has a show, one of your NFTs could be the ticket to my show, yada, 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 yada. I mean, if the Bored Ape Yacht Club, which is the number one NFT collection, Justin Bieber or most of the celebrities own one. I think Justin Bieber owned one, a piece for 1.5 million, and it was recently priced for 100,000. So literally, it dropped 90. Couldn't find its way to make their NFTs much more advanced and not dropping like that. How can any of us, okay, can turn our NFT collection into something valuable? So right now, buyers of NFT collection, the entire collection, like myself, are extremely skeptical. Okay, very skeptical. And the second reason why is because of this way. I asked that founder this morning when I was on a call with him. I said, look, $250,000, sure, I can write you a check. But if the market were to be at an all-time high right now, Bitcoin at 69,000, Ethereum 4,300, Solana 200 and what, $68 or whatever the case may be, sure, I would write you a check. And if I lose it, oh well, because the market is at an all-time high. But that's not the case right now. Everyone in this room right now, if you have $250,000 in your bank, what do? Would you A, go out and buy yourself an NFT collection and own it? Or B, go out and buy solid investment? How home prices are dropping, you can buy a home, or you can buy two homes with that amount of money and rent it out, so you can have an income. You can actually buy, and again, this is not investment advice, I'm just giving an example, people, just in case this is recorded. Okay, don't say, oh, Jenny said to buy this. No, 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 this is a disclosure. I'm using the names as an example. This is not a recommendation to buy. So going back, so if you have 250,000, you can buy stocks like Tesla is down. Okay. You can buy stocks like Amazon is down. Meta, Facebook is down. All of these stocks we all know are solid assets that are currently 60, 70, 80% on sale. Okay. So if you put $250,000 in those assets, not investment advice, people, a year from now, think about it. What would your chances of that $250,000 become $500,000 or higher with those solid investment versus buying an NFT collection that A, you're not the artist, you weren't the founder, you don't know how to build a website, and then after you buy it, what happens if they all quit? The founder goes away, the artist of that NFT collection say, oh, Jenny, good luck to you, but you know what, I'm gonna go off and get married soon, and I'm gonna have a baby, so find yourself a new artist. And then the developer of that NFT website say, Jenny, go find yourself a new website developer, because you know I'm gonna go to the Bahamas, you know, I'm so tired, I don't want to do it. Because you can't lock, the law is, you cannot lock a human being in an acquisition. When if I write a check for 250,000 to buy that NFT collection, all I own are the hard, I wouldn't call them assets, I would call them a commodity, the hard commodity of all the NFTs, what was done or whatever, and the idea of it, that it could be 400,000, 500, 600, or $1 million. Okay, so my take and my answer, which goes back to Stephen, is that, which I did advise that gentleman this morning. I asked him a tricky question, which he failed to answer, you know, until I kind of pressure him 2 or 3 times. And then he kind of caught what I was trying to ask. And then he answered correct. What was the tricky question? If all of you guys were to be on a one-on-one Zoom with me in the same position, how would you answer this question? Okay. And here was the question. I asked him, I said, hey, founder, if you do have that $250,000 in your bank today, the same amount that you wanted to sell your entire collection to me, but somehow it magically sits in your bank, would you keep going with your NFT collection? It was a tricky question. He did not catch it, that it was a trick. So he danced around. If he went out and said straight up and said, oh, fuck yeah. I mean, if I have $250,000 in my bank right now, Jenny, I love my NFT collection so much. I founded it. It's only been 6 months. We made 200,000. I just need a little bit more capital so I could do the collection 2, collection 3, the entire roadmap that I promised the people. Fuck yeah. Okay. Give me 250,000. I'll continue. That would have been the answer that I was looking for, because why? Passion. His passion was there. Okay. He founded it. Right now, bear market, living, Ethereum is down, his wallet's down, he's depressed. He loves his collection, but he wants to, he just needed a little money so he can finish up, the collection 2, 3, and 4, whatever the roadmap might be. But he's all in because passion is there. Google it, people. You cannot succeed in a startup if you don't have passion. If you don't have passion, it is just basically a game. It's just basically a hobby, okay? That because it was in the bull market. So everybody's doing NFT collection. So you went out and you do an NFT collection. It was a hobby. So his first answer to me, he stumbled. He danced around. He gave a couple different answers, but it wasn't the answer that I was looking for until I pressure him 2 to 3 more times. I said, founder. I didn't ask that question. Just yes or no. If you have $250,000 sitting in your bank today, will you continue? It wasn't until the third time did he say, yeah, I would continue. But then that was too late. It was weak. So if he himself was that weak answering my tricky question, why would I put out $250,000 to buy it? Okay. So that, what I've just shared with you guys, the last 5 minutes, was VC 101. Those should be some of the questions that legitimate VCs who acquire or invest into people, they have to ask. It's a part of the due diligence process. A lot of the M&As, M&A stands for mergers and acquisitions. A lot of the M&As happen sometimes. The DD, which is the due diligence process, takes 6 to 12 months before that acquisition or a funding would even happen. Okay. So my take is, those of you who do own an NFT collection, like that founder, if you would have asked me, well, Jenny, okay, so what do we do? I have an NFT collection, Jenny. I'm like that guy that you just talked to this morning. But, I sold about maybe 78,000, 80,000. Okay. But now I'm stuck. Nobody wants to buy a freaking NFT anymore. Okay. So what do? My answer is, if you ask me that question, my answer will be, number one, go ask the man or the woman in the mirror if he or she has the passion. If the answer is a confident yes, which is me, I'm building projects. Anyone who asks me, people around me, oh my God, I would not touch a project unless if I lose sleep building it. That's passion. Okay. So if the answer to that question to the man in the mirror or the woman in the mirror said, oh, fuck yeah, I'm going to build this, I'm just, I just run out of money. I just need, but then you know what? Go raise money. That goes back to Steven's question. It's called Reg CF. Google it. Reg, REG, CF, which is C for Charlie, F is in Frank. What is Reg CF? Regulation crowdfunding. What the F is regulation crowdfunding, Jenny? How does that help me? Okay, to make it very simple, okay, fundraising in the traditional side, Wall Street, has always been for the wealthy. It's called accredited investor. Okay, if you don't know what that is, go Google it. Okay, but the Regulation CF, which is Reg CF, it has now made it for the ordinary people. So to make a summary, back to that founder that I spoke to via Zoom this morning, if you do have the passion, and if you all you have is you needed money to ride this out, get more collections up, so when the bull runs comes back, this project is still yours. You're still the CEO. You're still running the show. You want to prove to the world that you are that all that CEO and you're not doing it as a hobby. Go raise funding and keep going. Why is Regulation CF good? Is because anybody can write you a check for $2 or $3 or $4 or $500 to own a piece of your company. It's easier for 2,000 people to write you a check, $500 each, then that's $1 million people. For you to have that $1 million to continue with the project that you founded, that you have passion for, to continue scaling it to a company or to a legitimate project that it should be. That is Regulation CF, and that is what you should look forward to, not selling your NFT collection, because trust me, smart investors right now for $250,000, unless it is a solid Web3 projects, but NFT collections, you won't get any sales right now. I will conclude right there.
Yeah.
I hope I answer your question, Stephen.
I got a question for you, Jenny, if you don't mind.
Sure, sure.
So yeah. So on this fundraising um, uh, regulation CF. So let me give you a little bit of background. I've been building a regulated infrastructure, basically at Web 2.5, which is basically under the premise that DeFi will be pushed into regulation. DeFi projects, as they're not entities and well, DAOs, would need to get certain components of their protocols that touch into regulatory sensitive activities to be able to comply with certain regulations, including systems that do AML KYC for DAOs without processing personal identifiable information, other various securities regulation, etc. It's basically a regulated sandbox in which a DAO can deploy a protocol and can safely kind of MVP and do the first go to market without going through the procedure of licensing, etc. And once they get traction, then they can go seek, licenses that are more fitting with their size, etc. Obviously, this is an infrastructure project. I have spent probably up until now around $3 million of my own money in it, etc. These infrastructure projects are very heavy capex intensive, etc. So obviously, while we were doing this, I was looking always into, I can't be the only guy investing in this on my own money, etc. So time to bring in investors, etc. So as you know, the VC environments in the last war on were looking for Ponzi-nomics. So the VCs discovered that they can get early liquidity into very early stage funding. This is basically the Pandora box for any VC. So obviously, the liquidity issue is a huge topic for seed investments. This allows them to basically have a huge multiplier effect on what type of deals they can enter to, and they can have early exits, etc. As you know, and one of the problems that happens here is that obviously all the VC money wasn't looking into getting trapped into heavy infrastructure project, although that is the resilient plan, that's the future plan. That's where this thing is going to evolve because regulation is going there, etc. Everyone was aware, But at the same time, they had much closer opportunities where they can cash in on liquid investment opportunities, and that's basically Pandora for that's Pandora box for a seed investment capital, because the cycles are longer, the risks are higher, and they were basically able to multiply. So obviously, infrastructure projects, although everyone was talking about them, they were kind of excluded from the capital allocation that happened in the last cycle. And during the last cycle, we looked into going into Reg A Plus or other forms of crowdfunding, and being able to kind of go and to pitch into retail. But the problem there, and we find it really funny, because the problem there is that the burden on the paperwork, especially if you are an offshore located company, etc., it's very tough. It's not only very tough, but the process is long. It takes 18 months to 12 months in order to get the paperwork together, and obviously various filings with the SEC for Reg A Plus, etc. So this process is very long and very tedious, and I think prevents a lot of people from going seeking capital in organized and a compliant manner. An easier way to do it is basically the DAO, go and solicitate funding in an unregulated, uncompliant manner. And that's the problem. So for me, the biggest burden here is, like, I solved the problem of being able to test early regulatory sensitive protocols into my sandbox. I was looking for a solution for people that actually thought about the same thing, is giving a fast track to people like me that were looking into introducing, going for capital introductions, and being able to kind of, onboard a type of a sandbox that will allow to accelerate this capital traction process. And this is my question to you. Do you see in the environment any kind of structure that thought about accelerating and streamlining this process to enable as many people as possible to access capital?
Well, the quick answer is no. Um, and I'll share with you why. Um, Capital comes from just a few number of sources. Uh, an independent angel investor, which what that means is it's a high net worth investor. Um, a group of funds, hedge funds, private capital, VCs. VCs, they invest money from investors. Sequoia, Andreessen, they go out and they raise money because of their large, well-known names. Look up Sequoia, look up Andreessen Horowitz, A16Z. It's them. Most of them, um, uh, are very well known. It doesn't matter how many projects they've backed that has gone belly up. The ratios are usually, um, out of 10 projects, 8.5 would go to zero. They would be like, you know, an FTX. But it's the 1 to 2 that hit unicorn statuses, okay, that would make it up to the 8 that they've lost. Okay, that's the VC world. Okay, so the reason why it cannot be automated is because it has to go through what is called a due diligence stage. Okay. Admin, when you mention about automated,
I,
if you go ahead.
I say streamline, but yeah, we're saying the same thing.
Right. So streamline, automated, they're one of the same. Tomato, tomato, right?
Uh,
So streamline, auto. The reason why it cannot happen is because unless, well, Elon Musk is getting into AI, we're talking about a lot of AI these days. We talk about how AI generated, our pictures. Senza AI, which is the app that's kind of gone viral the last week or so. I've actually my Twitter PFP is from that AI. You pay $7 and you upload 10 or 20 of your pictures, and
Mm.
the AI generate a bunch of pictures of you, like I tweeted, mostly they generate for females. I don't know why. They just made all of our boobs like 10 times bigger. Okay. Um, I don't know the purpose of that, but until AI is smarter, okay, which at the moment it has not been proven that way. Okay. I know, I'm not sure if everyone in here knows Elon's other side project called Chat GPT. You guys heard about that, right? Chat. Okay. Um, so even that is getting smarter, and they believe that Chat GPT could dethrone Google. Okay, we'll see how that goes. But until AI gets to where it can do what human beings do, which means it's got to be like much smarter, okay, automated or streamline funding is not going to be here anytime soon. Now,
Here's something for you, Jenny,
uh-huh.
without interrupting you. Are you familiar with the concept of SPACs?
Of course I do.
Okay,
What
so
about SPACs?
there is a so while I was talking to a lot of attorneys in the U.S. about the Reg A Plus and all this stuff, um, obviously I get a lot of interest because what I've created is a regulatory sandbox. So a lot of these guys that are looking into compliance, lawyers that are in the compliance field and regulation field and securities law field, they kind of get interested in what I do, right? Because I kind of found a way to, when DAOs are forced to get to become compliant, then a lot of them will come to me because they would want to adopt a model where quickly gives them the necessary requirements while they fix their issues with the regulators in various ways. But there will be a flight to safety at a certain point, and I can benefit from that. But this discussion basically gets us usually when I talk to security lawyers and these type of qualified opinions. Um, uh, we get into an innovative talks, and one of the things that we've talked about, this was in 2020 when SPACs were a thing, so in 21, um, they talked about a model for SPAC like SPACs, but for Reg A plus. So you basically, what you do is you do one application um, that is not project specific, but in terms of utility of the project, but it defines the broader lines. You do one application, and it's basically the same concept as SPACs. So SPACs was obviously an innovation in 2021 for being able to introduce a company, blank check into the stock market. The idea is to do the same thing, but for Reg A plus. So you do one application, you have a leader, for example, like you, that does the application, and you use those funds that you have raised in order to invest in specific projects which fall within the broad line of what you have disclosed to the agencies, to your filings. So that could be something. I think it's a brilliant idea. I think someone that has an entrepreneurial spirit should try it. Obviously, me, I can. This is not something in my scope, but definitely, basically, I wanted to run it by you because you seem to be involved in these environments, and it could be very beneficial for small. Because what ends up happening is that very few projects benefit from the regular. I mean, the we're talking about few $1 billion here of traction of evolution of this Reg Plus abilities to raise money, but it could be much greater if we have a way to streamline it. And one way to streamline it is to adopt the same SPAC model, but for the Reg Plus kind of target companies. which are smaller startups, lower capital requirements, and a more generic type of description when it comes to what are you going to invest in, and a certain level of disclosure to your investors. That's the idea, basically.
Uh, okay, so without boarding the folks, just in case they're not familiar as much as you do, I dispute of what you've just said, that SPACs were something innovative. It's not. SPACs was just another name for reverse mergers. Okay. SPACs is basically another name for reverse mergers, and reverse mergers have been done on Wall Street for who knows when, probably, since I was a kid. Okay. It's been at least 20, 30 years ago. Um, if those were to say, well, what is reverse merger? I know you guys can Google it. Reverse mergers are basically a shell, okay, a publicly traded shell. Let me give a very simple explanation. Let's just say Steven, okay, he's my friend and he's my partner, so I get to pick on him. Say Steven, um, uh, is a co-founder uh, in a medical device company, and his partner is a medical physician. Okay. So both Steven's partner and Steven took this medical device company public. Okay. Then his partner, the medical physician who innovated a lot of these medical devices, because Steven is the businessman. And so he runs, let's just say Steven is the CEO, but the company is heavily dependent on this medical physician who knows the medical knowledge to invent all of these medical devices. So let's just say his partner went on a private jet and that jet went down. Okay. Got killed. So now Steven, he's not a medical professional. What is he going to do? The company is publicly traded, right? So that company, without that medical physician, it has no more growth. Of course, it can sell whatever the medical devices that he had already invented before he passed away. Okay. So usually companies like this, it becomes a shell on Wall Street. A shell is a publicly traded company that has nothing in it. So what happens is uh, private companies, say, let's just say Jenny Ta. Let's just say I have a privately held company, and who knows? Usually the process to go public takes 5, 7, 8 years. Facebook, it took them 7 years before they could go public. Twitter, it took them 8 years before they go public. So back then, 10 or 15 years ago, um, people would go out and pay for these publicly traded shell, SHELL. It goes anywhere between $250,000 to $300,000 or whatever the case may be. So let's just say me, I go out and I found Steven and say, hey, Jenny, if you want to buy a shell, I got a shell. So I pay him, let's say $500,000. So I take over all the assets and liabilities, and then I rearrange it, change the name, file the paperwork with the SEC, change it from a medical device company into Jenny Ta's Web3 company. That's a SPAC, people. Okay. So that's exactly what a SPAC is. So instead of using the terms reverse merger, Google it. Tell me if I'm wrong. Okay. Go Google if SPACs and reverse mergers are the same. They're one of the same. So there's nothing innovative about that. It just became popular because you got some of the big names started pitching about it. Okay. So the final thing, Admin, because you were comparing SPACs with Regulation A plus. They're not the same.
No, I
Okay.
wasn't doing that. Let me correct, just if I may.
Okay.
No, what I was saying is this: is that where, and this is a good analogy that you brought up, a reverse merger. In a reverse merger case, you have a company. that wants to go public that buys out a company that is already public, and there is a defined in the filings there is a defined acquirer, okay, and usually there is some type of uh, uh, common or some type of possible integration, so that reverse merger kind of would make sense in general for general purpose, or sometimes there is a complete change of activity or and name, etc., etc. But there are certain definitions, there are certain variables that are predefined and that are disclosed. In the innovative part, well, you cannot, if you don't want to call it innovation, we can skip the innovation part. But what was new in the SPAC concept was that it was a blank check. So basically, you IPO basically a blank check. So you didn't have any visibility. You knew who was going to lead that effort, but you didn't have a clear definition on what specific companies and what specific deals are going to be introduced by that SPAC. Why is that important? Um, it's because it gave the capital, the person running that SPAC, great flexibility into bringing in a variety of deals. And what the impact of SPACs and what they did effectively in the VC world is to offload and bring liquidity into later stage and basically kind of streamline this process of going public to a bunch of these late revenue or no revenue companies, which had issues going public because you needed to have a certain level of revenue. And that brought them bigger liquidity. It offloaded them. It removed them from the pipe, from the VC pipe and non-liquid pipeline, etc. So it brought a lot of liquidity into that environment. And that is my exactly my point. My point here is that Reg A plus and other means of going seeking public funding, these are great tools if taken one by one, and they're also these are great tools, and it's a great framework for giving clarity on a path that small businesses and early ventures can go and seek financing from multiple how do you do it in the US? But from multiple basically retail investors, and and what I'm trying, what the thesis here that I'm trying to push forward is that if we had something that is similar to the that has the same characteristics as SPAC had, meaning that you do one application and that application kind of have a scope, raises the money, provides certain level of capital, and that capital is basically after that allocated to smaller ventures, which will basically effectively bring bigger liquidity, much larger liquidity to early ventures, allow them to have a different path much quicker than going through the VC. And we know that VCs can be extremely picky, extremely discriminative, and they all basically pick the same companies, etc. And basically just include and give more opportunity to much bigger range of companies in early startups to have access to funding in a regulated, in a compliant manner, rather than having people to be forced to go the unregulated route, which is basically doing ICO or doing airdrop or do things that are not compliant with security.
Right, you're basically just describing a regulated IDO, right?
Exactly. A regulated IDO, but where there is a certain level of organization behind it, meaning that someone has applied for a Reg A plus or other schemes that fall within the same path, and there is a leader, and that leader basically kind of has a blank check from all these investors and provides allocations in places where VCs are not necessarily looking, or just being able to include a much broader range of startups.
Okay, I mean, I saw two hands. I believe the host had a hand up, and I believe Lucas has a hand up. But I wanted to mention two things real quick, and then we'll get to the hands. And then I gotta exit probably in about 10 minutes. People. But I wanted to mention what admin just said. That I believe is extremely misleading. I'm not saying that you're wrong, admin. This is not just you, but out there in the public is extremely misleading when they don't understand about SPACs. Okay. First of all, if we all agree that SPACs are just a form of a reverse merger, and please do Google it, they are one of the same. It just how it's being packaged is different, but it's just the same. SPAC is another term for reverse mergers. And those who are saying that companies who go through a SPAC is because they're weak, is because they are their financials are not all together, or they're not a business that is profitable or whatever. That is 100% wrong. Okay? Let me give you a few names of reverse mergers that are successful. Did you know that the New York Stock Exchange went through a reverse merger, which today we would be calling it a SPAC? Did you know Warren Buffett's Berkshire Hathaway went through a reverse merger, which today we would be calling it a SPAC? Did you know Ted Turner, okay, Blockbuster, well, they went bankrupt. Burger King also went through a reverse merger. And also, I believe Jamba Juice went through a reverse merger, which today everyone is calling it a SPAC. So, yes, while there are companies, which there's always are, using a SPAC because they are weak, their finances are not all together, but there are legitimate companies who are really strong financially. They go through a SPAC because they do not want to wait for the filings to get public on the front door. Okay. When I was on Wall Street, when I explain it to people, I tend to use the terminologies front door or back door. Front door is called an IPO. When you go to the front door, you got to file a lot of messy paperwork, legal fees, and everything. If I have a company that is strong, I'm still going to take the back door, which is called a reverse merger or a SPAC, because I just pay the fees, boom, I'm publicly traded the next day. Just because I'm going through a SPAC, that doesn't mean my company is weak. Hence, Burger King, Warren Buffett, the New York Stock Exchange. So don't conclude it that way. So that's number one. Number two, admin, you keep comparing, not comparing, but you using the SPAC as an analogy for Regulation A plus, so that you can fit in the definition of having it some sort of a um, uh, 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 streamlined, automated. Here's why that will not work, admin. The reason why SPACs has that, let's just call it the package thing, is because it's publicly traded. Okay. A lot of the fundings, the stock is publicly traded, it has liquidity. Regulation A plus is from a private entity. Okay. Two different ball games, and I don't want to get into it. So trust me, if it could be done, it would have been done already. Okay. But when you raise funding, there's the due diligence process is lengthy, and it has strict rules. Okay. Even the Reg CF that I mentioned earlier. Okay. So um, that's why my simple answer earlier is that fundraising, if it's Reg CF, Reg A plus, 506CD, Reg D. There's a lot of them. It cannot be streamlined or automated. It has to still continue with the traditional method until, who knows, probably going to get more advanced. But we're dealing with people and their money. It's the two most difficult things in the world. Dealing with a human being, another human being, is already difficult. We all know that. And dealing with their money. Okay. You know how difficult that is? Okay. So those are the most two difficult things. So that's why it's normally manually done. SPACs and reverse mergers are different, and they nickname it a blank check. A blank check because it's publicly traded. That's why it's called. Okay, think about it. Common sense. Why did they nickname it a blank check? Because it's publicly traded. Every morning when the stock market opens up, you have buyers and sellers in that stock already. So literally, it's a blank check. Okay, so I'm gonna pause right there. So I agree to disagree with some of the things that you said, Admin, but majorly, I disagree. Number one, about SPACs that all SPACs are horrible companies. That's not true. Okay, SPACs are reverse mergers. Reverse mergers have been done by some of the largest companies in the world, and they're still in existence to this day. And Regulation A plus cannot be quote unquote streamlined or package it up like a SPAC, because one is private, one is a public domain, a publicly traded company. So Lucas, you've been patient, having your hands up. I'm not sure if you had a question
think
for me,
Josh,
but
sorry.